Hey everyone, welcome to the Real Estate Reveille, your dose of real estate inspiration. I'm your host, Daniel Colletti, and I'm passionate about helping you unlock the secrets to financial freedom through real estate investing and entrepreneurship. Whether you're a seasoned investor or just starting on your journey, you'll find practical advice, market insights, and actionable tips to help you build a thriving real estate portfolio. Let's dive into the world of real estate and take your financial future to the next level. All right, everybody, welcome to the Real Estate Reveille. I'm here with Victor Collazo from Extraordinary Assets. He is a fellow veteran and also a member of the Warrior program with Khlief. So we got some warriors on two fronts here. Welcome, Victor.
Thank you. Appreciate it.
Well, thanks again for joining me on the podcast today. Why don't we go ahead and start with a little bit of introduction of yourself? Where are you from? What did you do before you got into real estate investing?
Yeah. So thanks again, Daniel. Appreciate it. So Victor Collazo, I'm out of West Palm Beach, Florida. Originally from Chicago. I'm prior military, prior Army as well. Spent 10 years in the Army. After that, I went into IT. So currently, my day job, I'm an IT project manager by day. And so I've been in real estate for about 3 years now. On the multifamily side. I was on a single family side out of Orlando area. I did that for about a little bit over a year, and went to a couple different boot camps, and it was a mind shift, towards the real estate, towards the multifamily. The light bulb kind of went off in terms of the going through, the shifting from single family to multifamily and how and why or whatnot. So, but yeah, and that's where I'm at today.
Awesome. And what exactly were you doing in IT? Are you still doing that at all, or?
Yeah, so I'm an IT, I'm a project manager.
Okay, awesome. Um, and a little bit about your family. You married, kids?
Yep, I have my wife Erica. She's in cybersecurity. She's a cybersecurity manager, so she's also an IT, but different aspect of it. And so she works for a bank. And then we have kids. We have a 22-year-old. He's in the Florida National Guard, so he's following. He's on the enlisted side. I'm trying to push him to the officer side. Have a daughter out of Chicago area, and another son up there as well.
Awesome. Yeah, there's a lot of shade, sometimes it comes on to the officer side about crossing over there, but I'll tell you what, the retirement looks a lot brighter, for sure.
Exactly. Oh yeah. Yeah.
And, for those listening, Victor and I kinda connected, I saw he was in Palm Beach, and that's where I grew up, and so I immediately was like, "All right, I gotta connect with him," which we gotta link up when I get down there. I'll be heading down, end of next week, so,
Nice.
we'll grab a coffee or something.
Yep.
Um All right, man. Well, awesome. Why don't you jump into a little bit? How did you get started in real estate? And then why did what was the light bulb? Why did you see that as, the way ahead?
So I started with the single family side, and I intentionally, I was doing some property management myself, but I did it intentionally because I wanted to learn pros and cons, the good, bad, and different, and I knew there was going to be challenges. I went to Rod's boot camp a couple years ago. I didn't join right away to the Warrior Group. Then I went to Grant Cardone's, and then I went back one more time to Rod's. Unfortunately, it took me 3 times to really have that light bulb go off. But basically, you don't know what you don't know at the end of the day. I didn't know what a GP was. I didn't know what an LP was. I didn't even know I could own a apartment building. Most of us drive by or live in those apartment buildings, and we don't think we can actually be an owner or partial owner or an investor in these buildings. So, uh, you know, I met somebody who's got 50 units, and who had 50 units, and they said, "Look, you can think about it like this. You can spend one closing, one property, one asset management, one property manager with 50 units, or would you rather try and buy 50 different houses, 50 different closing, 50 different roofs, potentially, 50 different property managers if they're not in the same area, which I would hope. But so it just made sense from a scaling perspective and from a risk perspective as well, right? If one person moves out of that single family home, then you're 100% vacant. We'll talk about it later, shortly here. We have 92 units. If 5 people will move out of our asset, yeah, it hits our cash flow. And yeah, it sucks, but we're still gonna pay our bills at the end of the day. We're not going to go we're not going to go broke, right, so to speak. So for me, it was more of a risk factor more than anything. You'll still hear a lot of people saying, "Oh, I'll get a duplex, live on one side, and rent out the other," and I think that's great, and there's nothing wrong with that. But for me, personally, um, the level of effort from getting a 50 houses versus 50 unit apartment building is a lot more challenging. It's actually easier to get 50 units than it is 50 single family homes. And at the end of the day, do you really want to have 50 different houses? you know,
Yeah, yeah. No, of course. That was kind of why. I mean, that's why I made the leap too. And for one, it was just taking too long. I was doing a couple single family things, and then I'm also in Pace Morby's coaching program and learning
Nice.
out how to JV and partner with folks and starting to raise capital and all that. And then I was like, well, why am I going to raise capital on one? And everything I was penciling out, it was like, well, I'm not going to get any cash flow. I'm not going to get return on that. It's all going to go to my investor, and then maybe I'll see the appreciation and some cash flow, after some rent increases in a few years. And
Yeah.
so, yeah, the risk was just a little bit higher, and when you add in, you know, 10 units, 20 units, 30 units, and start getting that scale in there, uh, you get a little bit more opportunity and margin to work with when you're bringing on capital partners.
Charlie Peters, one of the Warriors, he let me tell this story on the last hurricane that we had come through. He had about, I don't know, 60 or 70 different properties all throughout Florida and I think Texas, some other locations. And he was getting ready to, he said, if all his properties would have got hit, he would have had to do 60, 50, 60, 70 different claims. So think about that. 50 to 60 different claims that you would have to do on each individual property
Oh,
versus if you have one
this is like his
property.
single family portfolio.
Yes,
Oh
condos,
yeah,
single families, townhouses. Yeah. So imagine doing, let's put a hold on 50. Imagine 50 different claims versus one property, one claim.
yeah.
When he said that, I was like, that was just, it's a no brainer, at the end of the day, right? Who wants to do 50 claims? I don't want to do one claim.
Yeah, no, it's definitely simpler. Well, awesome, man. So, you got this property you just purchased this past year, 6841 West Shade Lane, and tell me a little bit about what market is that in? Why did you get drawn to that market? Uh, and a little bit about how you found this deal.
Yeah. So 92 units. It's a Class C property out of Wichita, Kansas. That deal, I actually met another warrior through the warrior program, and that's how I found the deal. It was actually his deal, and I partnered with other warriors, several of us, on this deal together. So that's how the deal came together collectively. Basically, so this deal was found by it was off market with again another warrior. It was an older gentleman, probably in his late 80s, and he had the rent where he wanted them to be. They were running about between $600 and $700 roughly, depending on the units. But he didn't update them. He didn't do a lot of maintenance, and so it was debt free. So he was cash flowing. So at the end of the day, he was making he was doing great. 92 units cash flow. I can't blame him for not wanting to bump up the rents. The occupancy was over 95%. So I mean, I don't blame him. But at the end of the day, what was lacking was the maintenance. So because he was just collecting checks, he wasn't evicting those that weren't paying at the end of the day because there was a couple of those. He wasn't maintaining the property. So for us, we saw that as an opportunity. Um, and so once we went in, we acquired the property in late June. We really started hitting it hard in beginning of July. Started working on maintenance on the property. We're going to spend, close to $1 million in capex overall. So, but yeah, so it's a classy property. It's a great location. It's a lot of employment in that area. There's aerospace. It's a major metropolitan MSA or metropolitan statistic area as well. So that's one of the reasons as well. Wichita,
The,
Kansas, not going anywhere.
yeah, and you said there was no debt on that, right? Tell me you guys got that seller finance.
No, I wish we did. That's the crazy part. We didn't. We actually, you know what's
Ah,
crazy? We didn't get seller finance. We actually paid, um, we paid 5.5 for the 5.5 million. 5.4 million, I guess, 5.45, whatever. We raised about $3 million. Our interest rate was 7.37%. So we paid the market interest rate and we're still cash flowing, positive cash flowing, even when at that interest. All the numbers just made sense. And we're very conservative in our numbers.
At purchase, you were cash flowing?
Pretty much, yeah. Yep.
Awesome. Um, so with you said 92 units, right?
Correct.
Are you doing renovations on every single one, or was there some that you guys are leaving alone, or maybe just cleaning up?
So we're doing a combination of renovations, and we're going to do some we're doing full renovations, and some we're doing light turns. So it just depends on um, the different apartments. Some of them need full renovations completely from top to bottom, so to speak, and then some of them just need some light turns.
Yeah,
So it's varied. So we're not going to do 100%. And we don't recommend doing 100% either. And I see this a lot right now in certain markets where there's a lot of sellers where they have 100% of the units renovated, but then when a buyer comes to purchase it, there's really not a lot of upsell or a lot of there's not much for them to. There's no what's the saying? There's no meat on the bone, right? And so for us, what we do is we do value add. We do our, we're going to do roughly about 70%. And then when we sell the properties in 5 years or less, we want to make sure that the new buyer has, some lift for them as well. We want to make sure that there's a reason for them to purchase.
awesome. Yeah, just to pause real quick for the listeners, because there's a few different roles when you do these large commercial acquisitions, and Victor mentioned earlier he was working with another warrior who found the deal, and there's sort of four roles or functions you can think within a general partnership on these types of deals, and there's the acquisition specialist who's going out and they're working the brokers and the off market direct to seller marketing, and they're hunting for those deals. You've got the underwriter or deal specialists, analysts that are looking to see, are these numbers going to work? What strategy is going to be the best play here so that we can get the return on investment, the IRR at the end of the pro forma to make sure that this actually is going to be a acquisition we want to pursue. You've got your asset manager. These are the folks that are going to be on the ground. They're going to go through, supervise your property manager, supervise your renovations, make sure that the pro forma is actually working the way that it's designed to, and that you're going to meet your business goals. And then your capital raisers, the folks that are primarily, everybody says everybody capital raises a little bit, right? But you want to have somebody who's in charge of investor relations, and they're going to be addressing the questions and ensuring that reports are going out, and making sure that communications are consistent, and you're addressing any problems there. And so those are the typically four roles. And as Victor mentioned, he was working with a GP who found the deal. And of those roles, where would you say that you are mostly working in?
So on our team, we have a really good solid team. We have a great solid team that has years of experience, have done multiple deals, have seen them, from start to finish, full cycle. In other words, a term called full cycle, where basically from acquisition through sale or refinance or what. So the reason I bring that up is each of us do asset management at the end of the day. So we're all, from our team perspective, all of us are doing asset management, and then all of us we're doing capital raising as well. But at the end of the day, what I do specifically, I do the project management, and I also do the investor relations side.
Awesome. All right. So working with all the limited partners that are bringing the capital in, and you guys syndicated on this, right? It wasn't a joint venture,
Right.
JV.
Correct.
Awesome. Yeah, you said that's right. You said it was a $3 million raise. Was that right?
Well, we all about
Roughly.
2.8. Right. Oh yeah, a
And
little bit
then
less than 3 million.
and that includes, for everybody, that includes any kind of down payments or entry fees to get into the deal itself, your capital reserves, so that you can actually operate the business. People do it differently, but whether it's 60 days, 90 days, 4 months, whatever your plan is, and then the capital expenditure upfront costs that you need to actually execute your business plan. Did I miss anything there?
No, exactly, 100%. And it also sometimes it depends on the lender. So the lender will sometimes determine how how much reserves you need. We like to do, 6 months is very conservative just to be safe, especially in this market. We always want to be more is better than not enough. But some lenders will require 3 months, some will require 6 months, some will require 2 months. It just depends on the lender as well at the end of the day. But yeah, but you want to make sure you have your your capital expenditures upfront as much as possible, because what you don't want to deal with is you don't want to you don't want to acquire the property and then sell it. I do see this right now is I'm seeing some other operators are purchasing the property and they're trying to capital raise after the fact. And then what happens is they run out of money. And so if they don't, when they close, they don't get enough money for their capital. What they're gonna have to do is do what's called a capital call, or figure out ways to get additional funding or additional investors in to finish working on renovating, which is not bad, which is bad for everybody at the end of the day.
Yeah, you don't want to be that guy that has to go to your limited partners and say, "We need more money," because we didn't plan well enough.
Exactly. Hey, you gave us 50,000, but you got another 10,000 laying around, or
Just laying around, right? Yeah.
yeah.
All right, so you guys got into the property, you're doing some renovations. What's happened? Tell me a little bit more, what's happened since acquisition as you started to, work on your, renovation play? Oh,
So
sorry, before you
renovation.
get on that, just to elaborate on the value add strategy, right? Because you can go in and do development and build from the ground up. You can find really, run down properties and try to do full renovations. And then there's this next level, which is value add. That can both be on fixing up the property, but it can also be on identifying those shortfalls, like Victor mentioned, where this gentleman just didn't want to raise rents. And so there were some opportunities to be gained there. Anyway, so we're doing the value add play. You guys are in the property and you started your renovations. Yeah.
Correct. Yeah, we're doing renovation. We actually achieved above market rent or market rents. So some of the rents for some of the units we're not even supposed to get till year 2 and 3. We're already achieving those rents, which is great.
Awesome. Were there, did you have a lot of the leases that were coming up that you could already make those changes to? Was a lot of month to month, or how are you able to employ that so quickly?
So we had some evictions. We had, again, when you take over a property, you're taking over the good and the bad and the different, right? From the
Yep.
previous operator, you take off all. So what we did is we employed a new property management company, and we intentionally did that, even though the property management before was, I'm not gonna say they were bad. They were bad. It wasn't that. Just they had bad habits, they had old habits. They were with the owner for so long that we wanted to implement a new property management company that would be able to work with us on our strategy. And by doing that, we were able to, when the leases were ending, if somebody was moving out, what we would do is we had some of the units were empty. So what we do is we renovated those first, and then what we would do is for those when the leases were about to come at the end, we would offer those renovated units at the increased rent to that tenant. And most of those tenants would say yes, they wanted to stay anyway. So we just put them in those units, and then when they moved out, what we do is we're renovating those units every time somebody moves out, or if there's any type of a lease that ends or eviction or whatever that looks like. So we take, as soon as somebody's gone, next day we have a team in there already ready to go.
No, I love that strategy. I've actually been on the other side of that as a college student when I was up at Florida State. And you might imagine it was me and three other guys, or a bunch of college kids. So the apartments worked great. And when they came around and were like, "Hey, we've got this apartment," and it was literally the unit right next door that they just renovated. They're like, "Hey, it's $100 per person, so $400 increase in rent, and you guys can jump over into a brand new unit." And we were like, of course, let's do it. And so I've been
Right.
on the other side of that and just been like, yeah, of course we'll take a better unit for a little bit more money.
Who doesn't want a nicer unit at the end of the day? Nicer new cabinets. I mean, it may seem silly, but at the end of the day, you know, it's not it's not student housing, but most of the folks that live there have families, or it's family oriented, and I mean, yeah, pay a little bit more, but you have a nicer amenities, and I would too if.
Yeah. And so you mentioned identifying a new property manager, and I want to talk about that for a second, just to get a little bit about how that process went for you guys. And was your GP, is that a local market for him? Did he know people, or was this a referral you got? And how did you guys go about selecting the property manager?
Sure. So for the property management, what we did was we interviewed, I think it was three different companies, and what we did is we looked at we don't just look at, a lot of people, what they do is they say, how much are you going to charge me? What is the gross? How much is the percentage you're going to charge me as a property manager? Right. And people just focus on that number by itself. And that's an important number because it affects your NOI, at the end of the day. Right. But that's not the only number, right? It's not just about heads and beds. We interviewed them. We wanted to make sure that they were able to, that they had experience managing the same type of asset, the same type, the amount of, the amount of units as well. Because if they were only, say that they were only managing class A's and they were 10 or 15 unit properties that they were managing 92 units is a different type of scale. And C class property and C class tenants and residents is a little bit, is different as well. So we made sure it was somebody that's local. So we found a local company. We have a regional manager. We have actually a sales office there, a management office on site as well. So we hired, basically we did the interview process and we collectively decided that was the right management company for us, and we've kept them, and we've ever since we're good with them.
That's awesome. Yeah, for folks who were thinking about going to the multifamily space, that's the other nice thing about getting into the scale, especially 50 or 60 units and above, where you can actually determine, hey, makes more sense to have that property manager on site and in house in some ways to address some of those issues. And so uh, that's awesome to see you guys are doing that.
Yeah,
Um,
it was great. I was there about 2 weeks ago, 3 weeks ago. I went on site, and we do this all of us as GPs. We go once a month on site, physically on site, and we spend a couple of days
once
or
a
a week
month,
there. Yeah, once a month at least.
awesome.
Some people are there longer, and then we do surprise visits, which to our property manager. So she didn't know I was coming. We didn't tell her, and we went in. Like, hey, hello, I'm Vic. Which was great though. It turned. People hear that and they think, oh, well, they're going to find all these things wrong. It was amazing. The leasing agent knew half the staff. She'd only been there a couple of months, and she knew like everybody I walked through outside, all the tenants she knew by name. They knew her. She knew a lot of the issues. She identified a lot of things, which we'll go into here in a moment. Some lessons learned that I didn't even know were happening at the property that happened like the day before. So, but it was great. I spent probably a good half a day with her, talking about some of the challenges, some of the great things are going on, and it was great going on site, and which everybody should as an operator. I definitely encourage to don't just make the phone calls. Don't just It's great on Zoom, but when you go on site, it's a little bit different.
Yeah, I think I don't. You correct me if I'm wrong, but maybe some of the military background comes out there, where it's that trust but verify, and you got to go walk and do that circulation and see what people are doing and if they're doing it right.
100%. And when you go on site and you meet the residents there, and there's a lady there, I forgot her name. Really nice lady. She's been there 22 years or something like that, in a wheelchair on the first floor. Really nice old lady. And when you go there and you meet these residents and you tell them, hey, we're the new owner, and they see that you're doing things, everybody, I'm I'm not exaggerating. Every single tenant that I met at that time, they're out day and night, but they were very happy. They're like, you guys are doing amazing things. We appreciate everything you're doing, the renovation. They were very grateful. One lady was going to move out, and she actually decided to stay because of the renovations, things we were doing because of the changes. But yeah, you go there, you meet the tenants, and then when they meet the owners, a lot of operators, a lot of residents don't ever meet the owners of the buildings. And when you go there and you meet with them, they're like, their eyes light up. They're like, wow, you actually care, and we do, and we truly do.
That's awesome. Yeah, I think I hope most people that are getting into this business recognize the impact that can have, and you really are taking care of people, right? You are providing a home for these people, and so being a landlord is something to be taken serious, and that's awesome that you guys are doing that.
Yeah,
Um,
100%.
let's jump into some of those problems that you guys identified, and talk us through that a little bit.
So when I was on site, so we've had two fires and we've had two floods, actually three floods. Um, Unfortunately, one person was smoking So we have it's 2 stories, and there's wood balconies outside, and the person was on the top floor or second floor. They were smoking. Person that didn't live there either was a friend of a guest of the resident. They dropped their cigarette to the first floor, or I guess in between the cracks or whatnot, and they thought that the cigarette was out, and it wasn't. So, lit up part of the first floor. Thank God nobody was there. Part of the second floor as well, but they called 911. They recognized it right away. Thank God the most important thing was that nobody was hurt.
Yeah.
So, now we have to go through insurance. We have to do claims and go through that process. Um, so that was one fire. Second fire I think about 4 or 5 days before I got there, the dryer, going back to the maintenance that the last owner did not do, unfortunately, there was a dryer fire. And so the
Are
lint,
you
uh,
are
go
your
ahead.
dryers in unit, or do you guys have a separate facility?
No, we have washer and dryer, in the units.
In units, yep.
Yeah. Yeah. Not in every unit. We have it in some units, but not 100%. Um, but we allow them to bring them too if they want to. Like, if the resident has their own, we have no problem with them using their own.
Sure.
So, but this one unit, unfortunately, there was a dryer lint, and that's a big hazard. And most people, even in their own personal home, don't think about that or don't clean it out, right? So it's been, I don't know how long that lint has been there, but it was so backed up for, I can only guess, years, literally.
You got
And
a
that
brick
started
of
a
lint in
fire.
there?
Yeah, and it started a fire right there on the first floor, and then part way through the second. And we're like, "Holy smokes!" So, fire department came out. Thank God the lady was home again. Fortunately, people were home during this time, so they can call 911.
Yeah.
They put out the fires. With that said, we're going to have to go in, the way that these vents are made. They're old or a little bit older. We're going to have to replace the vents in every single one of these units, and that's an additional 30K plus that we weren't anticipating for.
Yeah.
I bring it up as a lessons learned because, you have your inspections, you have your appraisal, you have everything else, you walk the properties, but things are going to happen in this business. There's going to be a lot of great things that are going to happen, but sometimes there's going to be things like this, dryer events we do not expect. No one expected this. No one planned for this whatsoever. It was just an unfortunate accident, and now it's going to be an additional cost. So when raising capital, one thing we did is we have reserves. And so we're able to tap into those reserves, basically you raise capital and you raise a certain percentage past that, typically about 10% on average. And in addition, in case of cost overruns or things that happen. So it's not if things are going to happen, it's when they're going to happen and how much it's going to cost. And that's a lesson learned for us, and hopefully for others as well when they're raising capital. It's just is to think about that as well, just to make sure that they raise enough for when something comes up as well. So we learned from that one. It's going to be it's an expense that we weren't planning for whatsoever, but we did learn from it. We're going to fix it, and we're going to move on.
No, that's good. And you had, you said 10%, right? And so we mentioned earlier, you've got your operating expenses that you're going to have 6 months of, the capital expenditures, so your planned costs for doing the renovations, and then the actual closing costs and entry fees to get into the deal. And so, were y'all planning 10% on top of all of that, or was it 10% on top of your operating expenses, or how did you kind of navigate that?
Yeah. So what we did is we took about 10%. So it was part of our capital expenditures. So we
Okay.
estimate um, around, let's say, close to 900K roughly, and then we had about another 100K in expenses and contingencies, I guess, if you will, reserves, if you will, as well. For again, because we understand that things, you may have a bid for something, and and things do change, right? Because if you don't do something right away, and with the cost of, we know expenses are going to go up when it comes to construction, not down, unfortunately.
Right.
So we always plan for that just to be safe, at the end of the day. So
All right. So you had these two fires. You said three floods.
we had a flood. Same thing right before I was there. Unfortunately, there was a it was a dishwasher. And so in the dishwasher on the bottom, there's a little hose that connects to the sink. So on the hose, there's a little washer in there. Again, not sure how old it is, probably about a 5 cent rubber washer. It got corroded over time. The valve got corroded and it broke. So it broke. Nobody was home. So this is on the second floor. Excuse me. So that floor flooded. Then it goes down to the first floor, and that unit floods. So again, no one's expecting this. When you're doing inspections, you're not sitting there opening up a valve to check if a seal is good, right? Let's get real. No, you're not doing that, right?
Yeah.
So yeah, that happened right before I got there as well, right? Pretty much almost right after the fire. So we had to have a remediation company come out. That's another expense, obviously. We had to, the tenant we had to relocate them to another unit. And then while we were there, we basically, we did all the remediation. We painted, put new appliances. So we basically, a lot of people look at this as a crisis and they're like, oh my God, you're having all these challenges, all these issues. It's horrible. But we look at it also as an opportunity, right? You can't just think of it from a negative perspective. It's also, where crisis becomes opportunity, right? Because when at the end of the day, first of all, we want to make sure our tenants, our residents are safe. That's number one above everything, right? So we put them in other units as need be. But what we do is, again, when they're out, we take that time and that's where we renovate the unit. It may not have been on the business plan for another year and a half, but that's okay. We just, we may swap a unit for that was a year and a half, right? From that timeline perspective, you just adjust, you fix it, you overcome. And by doing that, we're able to actually bump up the rents as well, because now we have a new renovated unit and we can bump up the rents almost $200 in the unit that we weren't planning for. So again, but we had to pay off for what we had to pay for the renovation, pay for the, basically, to clean everything up and get the water guys out there, the dryers and all that good stuff as well. We weren't planning for that. So it's just part of the business. You don't, you can plan as much as you want. We're both, for military, you're still in, you know how it is. We can plan. It doesn't always go.
Yeah.
Things change, right? Before I go, right?
No, and I like that you brought the upside to it, because one of the things you got to think about when you're going to these is like, all right, how many water heaters need to be updated? How many dishwashers? What is the life cycle on every single one of these kinds of appliances? And when were they put in, right? So you may not have some of that information, and in something like this happening, now you know when this model of equipment was put in, what the life cycle is on that, and you can forecast, okay, this is when the services need to be placed on it, or when it might need to be replaced down the road. And so on top of the fact that you gain some capital expenditure value there, you also know where it is on your maintenance cycle, where some of that might be ambiguous as you're going into it. And then on top of this, again, just to remind maybe some of the new people who haven't gotten into the larger scale stuff, the property managers are having folks work this piece, right? You as the general partner weren't going in there and turning wrenches and mopping up or anything like that. Like these are, yes, it's your asset and you're managing the renovation of it and the repairs. But there are property managers who are actually reacting to the contacts.
Exactly. 100%. Yeah. So what we do is, and asset manager, the asset manager manages the property manager. Now that doesn't mean that we go with our eyes closed. So we know 100% of where all of our costs are going. We have weekly calls with our property manager. We have GP calls weekly as well. So we're on top of everything. When there's a certain budget that we allow our our property managers to spend. So we're in constant communication with them, which is, again, that's what we think we have a great property management company, because we have that constant communication back and forth. But no, we're not out there. I'm not sitting there calling contractors. We can, we have every opportunity, we have every right to choose what we want to do at the end of the day. Right. But, that's what we're paying them for. But no, they have the relationships there. I'm not in Wichita, Kansas. I don't have the relationship with a plumber or electrician physically there, right? They do, so they're gonna have that they're gonna know who to call, for those maintenance issues. And We have maintenance staff as well. We have on-site maintenance as well. Then we have a maintenance guy that does a lot of our punch work. So he's out doing a lot of the things that need to get done as well on a daily basis.
Awesome. Well, I'd like to, transition a little bit to the capital side of things. You're the capital raiser on this deal and other deals that you're working on. And can you tell us a little bit about how you manage the investor relationships? What are the draw schedules on this? The future return on investments that you're planning on giving to your limited partners, and are you on schedule so far?
Yeah. So what we're going to be doing is what we've projected is about we have a 7% preferred return to our investors, 70-30 splits. We have our estimate is going to be what's
Just
called about.
I'm
Go
going to
ahead. I'm sorry.
pause you
I'm
there
back
real
up.
quick. No,
Yeah.
yeah,
Yeah.
yeah, let me just pause you there real quick. So he threw out the pref, the preferred return, which for those who don't know that what that means is, you've got your 70%, 30% split between your limited partners and your general partners. And when you include a preferred return, that means that your investors are going to get 7% on their investment before any of the additional profits are split between the LPs and GPs. And that's just to provide that additional incentive that these folks are giving up their capital so that you can make the investment opportunity happen to begin with, and that helps incentivize that investment for them.
Yeah. Exactly. We need. We want to make sure that our investors are taken care of before. Investors are always paid before the GPs are paid. LPs are paid before the GPs are paid 100% all the time.
Yep.
So we're estimate, roughly we're going to have at the end of the sale 5 years or less. We estimate we're going to have to do what's called a 2x multiple, which, another acronym basically is the goal is, and if somebody writes a check for $50,000, when we sell the property, we're going to write them a check for $100,000. In other words, they double their money. So that's 2x's, whatever that multiple is. That's our goal. Um, our we have an internal rate of return of about 15 to 17% and annual average return about 20%. Um, so in terms of, that's holistically, when you look at the numbers, you have to look at your cash flow, your getting back to, to answer your question about the distributions. We do quarterly distributions.
Okay.
And that's going to begin roughly sometime. The goal is beginning of January timeframe. So again, we did have unfortunate capital expenditures that we weren't planning on. Again, it delayed us probably about a month, realistically. But we're still within our time frame.
Yeah. No, that's a good point to take note of too. Even for folks who are listening and might be considering being a limited partner, there may be a period of onboarding where you actually have to get the project stabilized before returns start to come out. So it may be 6 months, 8 months or so
Yeah.
before your quarterly distributions take place.
Could be a year. Yeah. It just depends. And to your point, you made a really good point when as an investor, I'm an investor as well in this deal and other deals as well. But for those that are listening, when you're an investor, don't be afraid to ask the general partners, hey, when do you expect to start distributions? Is it going to be a year? To your point, is it going to be 3 months, 6 months? Depending on how much work needs to get done. And what that does, it gives you it gives you an expectation versus, hey, am I going to get it starting tomorrow, so to speak, or is it going to be 3 months or what that time frame is? So you have a better outlook on what that looks like, and you choose to accept it or not accept it, right? It depends on what your goals are.
Yeah. Well, that sounds like it's going to do great for you guys and for your investors. So I'm excited to see where that goes for you. Before we move on, is there anything else that stood out about this project that you think would be valuable for folks to know?
Yeah, I mean, Wichita, Kansas. A lot of people, when I first started talking to the Warriors, like, hey, we have this deal in Wichita. I'm like, all right, where's Wichita at? And what the heck is in Wichita and why? I'm in South Florida, right? So don't discount these. At first, I didn't realize it was a major MSA, major metropolitan area. To be honest with you, initially, and so don't discount some of these areas just because Wichita may not sound like it's a it's a sexy area, right? It's not a Miami Beach or a Chicago or New York or whatever. I mean, I don't do nothing in New York, but the point is, it's not these a lot of the Charlottes, a lot of these markets, these hot markets or what. But let me tell you, I mean, my head, it's reversed on the camera here, but that's the name of the game for us. Cash flow, right? These Midwest markets, they do well. They do fairly well overall, and that's one of the reasons why we looked at this market as well. And it's just a great market. Like I said, I've been out there myself, and can give you firsthand experience. It's a lot of it's a lot of jobs out there. It's a great area. Families out there are just amazing. Good, there's good people, good wholesome people.
Well, yeah, and I think there's something to be said too to get away from those large urban centers where there's going to be a lot of institutional money anyway, and that's an MSA where the competition is probably not quite as intense, and you still have a lot of good opportunities and population growth and job growth to support it. Um,
Exactly. I mean, and the price point for what we paid for it, I mean, we were at what, a little bit less than 60, roughly a door. I got the number off the top of my head. I mean, you go to Miami, you're paying 220 a door easily,
Oh yeah, I'm shopping
220.
there right now. I'm potentially PCS in there in June, and I got my VA loan qualified for, and I'm looking for a 3 or a 4-plex, and it's like, I'm scraping the bottom of the barrel at
$9.
$900,000 for a
Yeah.
3-plex, and I'm like, oh gosh. So
Yeah.
yeah, it's definitely interesting down there.
Different market though. I mean, but the rents are in that market, not to go off on a tangent, but the rents
Yeah,
for
yeah.
Miami are they call for that numbers as well. So it makes sense. But yeah.
Well, yeah, some of that I'm looking at. All right, maybe the closer I get to the city center, the more likely it is I can do a short term rental in one of the units, and then that would really cover, uh, create some good cash flow. So there's definitely some trade offs there. But all right, I want to shift a little bit to talk about mindset. I think so much of this game and getting in the right headspace is important. um, I first bought my I bought my first property in 2018, and I feel like it's been nothing but a mental journey since then to get rid of a lot of bad assumptions and get into a mindset that is going to make me successful moving forward. And so, um, can you tell us a little bit about how your mindset has changed as you got into real estate? What have you found important? What practices that you think are critical for succeeding and just also enjoying this pursuit?
Yeah, so I'm a big believer in focus and discipline and and accountability and so a lot of that breeds success at the end of the day. If you do that pretty much almost every single day, you're guaranteed to do success. Whether it's in real estate investing, whatever it is you want to do in life, right? If you're consistent as well, that's a big thing with me is consistency, right? Looking at deals, talking to brokers, underwriting deals, whatever that looks like, going to meetups. If you're consistent, eventually, it will come to you. So yeah, but getting to mindset, I'm one of the weirdos that are, even though I'm out the military, I still wake up at 4:30 in the morning. I have I do my morning ritual, if you will. I do my affirmations. I do my silence. I think it's important, and so it helps me be a little more clear, especially making these decisions. Right when we're making these decisions, they're very important, um, very critical, very tactical, very strategic. So, a mindset, yeah, I mean, you have to have the right mindset, and it's easy to become very scared, have a scared mentality, to have a negative mentality. Oh, I'm never going to find a deal. It's been 3 months. It's been 6 months. Oh, I'm just going to quit. Right. It's easy to do that, but, you just have to keep moving forward. Right. We talked about ruck march earlier. It's just putting one foot in front of the other to get to that destination, right. To get to that point, you know? And so, but yeah, just staying positive, staying the course, staying focused. Don't get distracted by every shiny penny that comes along. Especially in this
Which
market, it's
is
so
different,
easy.
yeah. In
It's
this
so
game, you can
easy.
definitely do that.
It's so easy, myself included. It's like, oh, I want to do multifamily. Oh, and then you hear somebody do a podcast about self storage. Oh, now I want to jump into self storage. Now I want to do short term. Now I want to do flex space or this or that. And all those are great. I'm not downplaying any one of those. whatsoever, but learn one of them, get good at it, if not great, understand it. And then you can focus on the other ones, because if you start focusing on too many other things, you get this ADHD, the squirrel, then you may get confused, and it's going to be a lot less, um, possible that you may not take action as well.
Yeah, but especially that latter part, because I 100% have been victim to that. Where, going back to your ruck marching analogy, you got to keep moving one step forward. But if you keep turning down different roads, you never actually get to your end point. And I 100% went down the sub two creative finance, doing pre foreclosures and fixing and flipping and lending money, and it's like. Uh, these are all great things. It's awesome that I
Right.
know about
Yep.
these things now, and I can incorporate them in what I'm doing. But you got to get good at one thing and actually make progress on that one thing to get to where you ultimately want to go, which for me is, time and financial freedom, and being able to take care of my family. And
Yeah. And
so,
in your brain, it's like, what do somebody asks you, what do you do? I'm a fix and flipper. Okay, great. That's what you're known for. I tell people I'm an IT project manager by day and I'm a syndicator by night.
yeah, exactly.
I mean, a multifamily, I'm on the multifamily side. Now, I'm not saying I wouldn't do self storage, but I absolutely would if it makes the deal, the numbers make sense. But I'm not against other asset classes 100%. I have an open mind, right? But like residential assisted living, I don't know enough about it. I'm not educated enough about it, but I don't want to go down the rabbit hole so far that where I lose focus on my day to day, my end goal, from this perspective as well.
No, that's awesome. All right, man. Well, before we wrap up here, why don't you, do you got any educational resources that have made an impression on you, whether it's a book, podcast, or something that you'd like to recommend?
Yeah, a couple books. I just finished this book that Rod had sent over called The Slight Edge by Jeff Olson. I think it's a great book. And basically, it's just a way of thinking, and it enables you to make daily choices that are going to lead you to success and happiness you desire. Basically, it's not just about the things you do, it's about the things you don't do. Right. So it's a combination. A lot of us focus on what we're doing, but it's also the things you don't do. It's like, all right, if you go to the gym one day, if you go to the gym a second day, a third day, a fourth day, you may not see progress, but over time you will see that. But if you don't go to the gym that one day, you're like, oh, not a big deal. If I don't go to the gym the second day or the third day, you're not going to make that progress as well. Again, it's not just what you do, but also what you don't do. Same thing with eating. Oh, I just want that one donut. It's not a big deal. All right. Well, one donut, I don't know about you. For me, it turns into two. There's been
Yep.
almost about.
Yeah, I know where that
So
goes.
so, so it's a great book. I think it's a fantastic book. And then something else, 5-minute journal. I didn't really start journaling till several months ago, and I think it's great. And it's just a quick thing. It's a quick what you're grateful for. I sent some daily affirmations or whatnot. I can find that on Amazon. I can, provide the link if need be as well. But just though journaling has provided my day in a much more positive and clear day. And when you are grateful, it's hard to be upset, or have any negative emotion when you're grateful. You can't do both at the same time. I don't know about you. It's hard to be smiling and be angry at the same time, right? So
No, yeah, and I've really started. I've been much more intentional the last couple of months, and I've got my intentional journal from Brandon Turner, and I've also started. I've got my little journal that just came in from Brendan Bouchard, like that, and uh, I there's a noticeable difference on days that I don't journal about being intentional and, like you said, being appreciative about the successes or the wins that I have had that day and staying focused on what I want. So I 100%, that's awesome. And is that journal you have? Does that have like prompts in it, or is that just like a journal, blank journal that you use to write in?
yeah, so it has like what I'm grateful for, what would make today great, a daily affirmation, and then at nighttime you can do the same thing, like highlights every day, and what did you learn? So it's a quick 5-minute thing. A lot of people think you have to spend hours and hours journaling. You don't. I mean, you
Yeah.
can if you choose to. There's no time frame. The reason I incorporate that in my morning. I do Hal Elrod's morning miracle program. So it's that's part of it. And so in terms of that's why I like it because it's 5-10 minutes and I can focus and I just think it's great. Again, to your point, whether you have this journal, whether you have your own pad and paper, whatever that looks like, some people type it in their phone, whatever that looks like. I think it's a very, very beneficial, and it's provided me a lot of peace in my life that I've lacked for a long time.
Yeah, no, that's awesome. We'll make sure to get both of those in the show notes for folks that want to go check those out. Um, all right. Last but not least, where can folks get in touch with you, whether they want to invest with you or touch base about getting in on some deals? Where can they go to find you?
Yeah, so we're on all the socials, all the Facebook, Instagram, all the good stuff. But our website's www.extraordinaryassets.com.
All right, awesome. We'll make sure that's in the show notes as well. And so with that, I'll just say, Victor, thanks again for joining me on Real Estate Reveille. It's been awesome chatting with you.
Likewise, thank you, sir.